Hello, everyone, and welcome to another episode of Passive Income Doctor. Today, we're joined back by Dan Jones, who is a mortgage broker, a company called Specialist Broking, and also has a very interesting backstory as a pilot. And for those who are interested in that discussion, tune back into that episode, or first part, I should say. But today we're going to be talking a little bit more about the nitty-gritty of finance and what are some options available to doctors. Welcome back to the show.
Thank you, Dr. Dan.
So I guess we kind of touched on, and hopefully most doctors are considering or using mortgage brokers. But I'm a little bit surprised. I have some discussions with some doctors who are still like, oh, I like having a personal banker. Um, you know, uh, Easier. Don't have to be on hold so much with the big four banks. Or other people just say, look, I don't really see that much benefit in mortgage broker. They kind of ask for a lot of documents, etc. And I guess like any industry, there's degree in the quality of a mortgage broker or doctor or whatever it is. I guess, do you want to kind of discuss about what are some of the advantages of a mortgage broker?
That's a really good question. And there are 2 points here. One is a mortgage broker provides choice. So we are not bound to use one bank. Now, there might be one particular bank or two or three that are suitable for doctors in general, uh, but you can't assume that. There are so many different lenders in the market in Australia that it might not be the lender that offers the highest LVR, especially for, say, someone with a more mature investment portfolio. It could be incorrect to be going to the major bank because there's that idea they can do something for doctors. Sometimes it's right, sometimes it's wrong. And the second point I would make is a lot of my clients, when I introduce them to a bank, get a private banker, a dedicated
Mm,
private banker. So I or any other broker can facilitate that relationship. And that works really well as well. And the private bankers, if say 2, 3 years down the track, client has a different need or is growing the portfolio and there's a reason to exit that bank, a good private banker should accept it
okay.
because it's the right thing for the client. From the first episode, I referenced best interest duty. A banker is not bound by best interest duty. That's under the legislation.
Well,
They are bound by offering what the best option that their own bank can offer, whereas a broker must consider the whole market and find the best solution.
mm. Just curious, on a side note on that, because you know how some of the banks, like say Bankwest is owned by CBA, I think
Mm,
St. George is owned by Westpac, is my
correct.
understanding.
Correct.
So is it if a banker at Westpac, would they discuss St. George products, or would that be considered a different?
St. George and Westpac are very similar. There are a few policy nuances, and it normally comes down to security policy, so location of policy.
Okay.
Otherwise, income policy is quite similar. So St. George don't want Westpac poaching their clients and vice versa. At the end of the day, that they are the one bank. Bankwest and CBA are different in terms of, yes, Bankwest is owned by CBA, but they have very different policy. And there could be a very good reason to be with Bankwest and not CBA.
Yeah.
And they treat themselves differently.
Okay. And with the personal bankers, is that mainly the big four banks that have the personal banker or client manager or whatever they call it? Yeah.
Correct. Big four banks. Now, there are, and I won't name banks
Mm.
individually, but there are some of the majors that I will suggest not not having a personal or a private banker,
Yep. Okay.
because in my experience, it hasn't been a good result
Okay.
for the client, and it might even delay a purchase or cause a purchase to come under stress.
Yep.
It depends on the bank.
Yep.
And you've also got Bank of Queensland Specialists, which is going through an immense change at the moment. which is I still consider for the right client, for the right purpose. They historically had quite good personal or private bankers helping their clients.
Yeah. Um, And just on a side note, I think a lot of people, and maybe I've noticed as well, often CBA often gives higher valuations. Do you reckon that's just always been like that, or maybe more is it a seasonal thing? Like I guess banks, if they're more in a lending mode, they might offer high valuations to allow equity out. And also, I guess more anecdotally, more recently with post-budget 2026, sentiment bit low. Investor loans I heard have dropped off a cliff. And
Yes.
banks are maybe starting to be a bit more competitive to try and attract refinances.
Correct. And I've noticed that banks, even Macquarie, for example, has relaxed its valuation policy to make it easier to get the equity that's needed in property, particularly in the higher value areas. So they are competing against CBA. You're right, CBA have historically been known for having valuations that are beneficial to a scenario, particularly for equity release. I would say the gap's closing.
Okay. Yeah. Well, I guess let's talk about, yeah, I'm sure you get questions recently all the time, like post-budget, removal of negative gearing. Although my understanding is it's not so much removal, but kind of deferring, any negative cash flow against that investment property can be offset against future positive cash flow. I mean, it might take 5, 7 years for the property to
Yes.
become positive, but it's just you can't offset it against your personal exertion income now. But anyway, obviously, headline media, Sydney down, Melbourne down, a lot of people are saying property investing is dead. What are your thoughts and what sort of conversations are you having with your clients?
That's you've articulated that very well in terms of the budget. We've had global conflict. We've had three rate rises this year, and sentiment is down. For the investors, doctors and non-doctors who have I have seen do quite well, the rules don't have a major impact on them because they're focused on finding the right property for pure investment purposes. And we can talk about property portfolios and how they grow and what I've seen work well, what I've seen not work so well. But the changes for the right investment property, um, you want it to make money for you, right? In the long term. So you've got to manage the rules, get good tax advice, understand your budget, and you can still find good quality property in different areas. I would say in the capitals where it's speculative and you're relying on capital gains and historically wanting some tax benefits for the losses you're currently receiving, I'd be cautious.
Yeah, I think yeah, I've heard of it's not a strategy that I'm pursuing, but I know a lot of high income doctors or even yeah, I've heard say people working in the corporate sector earning, million plus, etc., maybe investment bankers, etc., kind of their strategy over the last 10, 20 years has been, yeah, buy like, I don't know, $2, $3 million, houses in the inner rings of Sydney, Melbourne, and it's like negative 100, $150,000 each. And I guess
Yes.
when there was negative gearing and you're earning a million, you might get 75,000 back. So let's say negative 75,000. For me, though, it was always like, if you hold 10 of them, like negative 750K after tax, that is still like you have no money left over. So it's not a really scalable strategy. But I guess even now, I think they'll be hurting even more if there's no kind of negative gearing. Their portfolio is going to be so negative that I don't know, maybe they might have to be forced sale or anything like that. I don't know. Have you come across any clients that are heavily negative cash flow?
Yes. And some of my uh, medico clients with significant portfolios, you can see a difference between those that have bought outside of the capital cities versus those who have bought close or in capital cities. One of my clients has fully recycled his property portfolio because it was not sustainable.
Right.
And that was a apartment. So he has a $2 million home and a $6 million investment portfolio. Within the last 2 years, he has sold every property
Oh,
and
wow.
bought new property.
Yeah. What
And that
made
was a
him?
cash flow issue. It
Oh,
was,
okay. Yeah, that was my question. How
yeah,
come sold the $6 million portfolio? Because, on paper, it sounds like doing very well, but was a $6 million like really, really negative, I don't know, a few
it
hundred grand a
was.
year and affecting lifestyle or just maybe there wasn't much capital growth as well. If you pick the wrong asset and you're just losing money, you might be like, what's the point?
He made, during the sale process, he made a loss on a
Okay.
significant portion, still wanted to invest, but do it properly.
Mm.
Or his version of properly. I
Yeah.
shouldn't say I
Yeah.
can't
Yeah.
dictate what's right for
Yeah.
one person or another, but he realized I'm in a cash flow um, issue here
Yes.
where, like you said, for just for lifestyle, for kids thinking about what can we do, when can we go on holidays, and you've got this cash flow hole,
Yeah.
it was not sustainable for him. So it was a full recycle of property. The generally the people who uh, in my view, seem to be doing well are finding properties that where you've got yield
Okay.
and they're essentially sustainable. Um, Even a non-Medico client of mine, he's a captain in the army. He's 25 years old. He's built a
Yeah.
$4 million property
Wow.
portfolio of about 9 properties. And the last few purchases, Darwin, Katherine
Yeah.
near Tyndall, uh, Port Headland in WA,
Yeah.
and Mackay.
Yeah.
High yield, but he's done the research and he doesn't use a buyer's agent
Mm.
himself because he is so passionate about researching himself. But he looks at what government contracts are in the area. Now,
Mm.
Tyndall, sorry, Katherine, for example, is 15 kilometers from Tyndall, and the property he bought, which can house 8 people, is utilized by Air Force fighter pilots who drive to Tyndall for work.
Mm.
That's not going anywhere.
Mm.
And the yield is astronomical. He will not need to sell because he has got such a good cash flow on those properties. So generally, if you even manage the yield in your portfolio so it's sustainable, you will do quite well, and you will typically hold on to your property portfolio longer and enjoy the growth.
Mm. Wow, 9 properties at the age of 25. I assume it started a while ago or started more recent. Do you know how many
He
years?
started at 19. So
Yep.
he was introduced to me. His father's a specialist,
Yeah.
and his son was introduced to me when he was 22. He had bought 3 investment properties,
Mm.
and we've grown that to, I believe it's 9 properties. I
Yeah.
can't keep
Wow.
up, to be
Yeah.
honest. And he's done that on, look, he's career-wise very successful as a captain in the army. Income, though, is maybe 120,000.
Oh,
So he's
wow.
done
I
that
would
on
have
the
thought, I
back
would have
of,
guessed more than that. Yeah.
I would as well. But he has been able to build that sustainably. No parent help. He's done it all
Wow.
himself,
Wow. Well done.
with that level of income.
Yeah. Yeah, I think that those are really inspiring and yeah, I know myself as well. Yeah, I didn't have any parental help. Obviously I started a bit later at 23. I guess that's when, kind of first job out of uni.
Yes.
But yeah, bit of I mean that's a side tangent also as well, the opportunity costs, for, say law or medicine or engineering, it's quite a um uh, long training path. So, maybe eventually you earn the big bucks, but for sometimes to become fully qualified doctor, specialist, it could be like 15 years all up. So then, if you start earning good money at 40 versus someone who's started investing at 20, that's 2 decades of compound growth.
And I think the in the scenario with the doctor, it's a huge investment, especially if you're becoming a specialist and going through a fellowship, and it's a long journey. But then income increases quite quickly.
Mm, mm,
So you might be a registrar, 150,000. 2 years later, when you finished your fellowship or whatever specialty, you could be on 700,000, maybe even $1 million. Now you want
mm.
that money to work for you
Yeah,
because you've spent all that time investing to get where you are now. Now it's time to grow your wealth. And there's other strategies as well that can help with that. Now, the new doctor, most of the major banks offer 95% no LMI to get a home. And that's one good thing. There are various debt, well, there are debt recycling options as well to help. I guess, maximize the net income that a doctor can take home, which can be used to invest.
yeah. Well, that's a segue into and obviously for everyone listening, this is general advice. Please speak to your accountant, financial planner. But just for people who are not aware, can you explain kind of debt recycling and how it may help some people?
Yes, and absolutely, this is not accounting advice. And I strongly encourage anyone who considers this to speak to their accountant and to get their view because there are differing views in the industry on this structure. And the best thing you can do is line up your ducks, make sure you're doing it properly. And when it comes to an ATO audit, if it happens, that you've got your paperwork lined up correctly. Uh, but the debt recycling facility, there's actually quite a few banks that offer debt recycling to doctors and to non-medical professionals as well. One of the solutions I have at the moment with Westpac, and I've got an individual private banker that helps facilitate this for my customers. You can borrow up to 95% buy your home. Now, as an example, you need a home loan of $2 million to buy a $2.2 million property. That $2 million loan is non-deductible. Uh, Through the debt recycling structure, the aim is to turn as much of that non-deductible debt into deductible. Then you can put it on your tax return. And this is particularly important for sole traders, for which a lot of specialists are, because it's hard to deduct much of that income because it's considered PSI or
Mm,
professional services income. You can't do much with it. But with this structure, every quarter we have to pay BAS. Every year we've got to pay personal income tax. Before we pay it, we are holding it for the benefit of the ATO. Normally, we'd put that in our offset account to reduce interest on the loan. Under this structure, we actually pay down the loan. So that say every quarter there is $80,000 of tax being
mm.
held for the ATO.
Yep.
Um, you you pay down your loan, 2 million becomes 1.92 million. The bank will then increase a separate split on your lending to bring your total limit back up to the $2 million figure. But that new $80,000 loan is considered a new loan, which is fully deductible because you have paid a business expense, which is your tax. With this process over time, including 4 quarters of BAS and income tax, over 4 to 5 years, we would be aiming to turn that full $2 million facility from non-deductible to deductible. Now, if you're paying an interest rate of, call it 6%, I know the rate would be higher now, that's another 120,000. I hope I've got my maths right, that you can claim in interest on your tax return, therefore reducing your tax bill.
Mm. Yeah, this one is definitely an interesting one when I first heard about it. I think some people say, again, yeah, you're right. I think different accountants have different advice or opinion as well. Some say, yes, obviously the BAS is a business expense and maybe you have a cash flow issue, but then some people or accountants say might need to pay down that debt at the end of that 1 year or end of financial year rather than keep accumulating? Because I guess it is attractive, isn't it? If every quarter 80K, three 8 times 4, 320K a year after 4 years, like 1.2 mil of deductible debt. Some accountants that are a bit more conservative might say, oh, the ATO might look at that and be like, oh, like,
Part
you,
for a
you
tax
know,
avoidance. Yeah.
yeah, I don't know. Have you heard any kind of counter arguments or is there any, yeah, other opinions or caveats on, I've heard, for
It,
example, have to pay it down per year or, or is there a limit or,
it's mixed. So, and that's why I come back to talk to your accountant. They might want to get a tax opinion. Now, having a tax opinion from a tax advisor is different to getting accounting or advice from your accountant or from anyone's accountant
Mm,
because it's a paper written up and it's not cheap to, I think it's about $8,000
well,
uh, to pay for a tax opinion. If you get audited, some accountants' views are, well, if you've got the tax opinion, you've nearly covered yourself
mm,
because you've done the research, you've gone in under this strategy with the best intent to do what the ATO wants.
mm.
Uh,
Do you mean a tax ruling from the ATO or just a tax agent giving you a tax
it's not
advice?
a rule. It's not a ruling. There are
Okay.
various rulings
Yep.
around debt recycling. Well, do you know what? The latest one was from 1990,
Well,
is my understanding. So it's a while ago. I can share it with you as well, so you can
mm,
uh, see what it says. But it effectively says if you have to pay your tax owed using debt,
mm.
then it becomes deductible.
Okay.
And this is where different accountants have different views. Some will say, I'm very comfortable for all my clients, all my medical professionals to do this. There's about 3 billion of facilities each year being set up under this structure.
Okay.
So it's not new, but I'm cautious. So
Mm,
I like my clients to know they should talk to their accountant. If the accountant says get a tax opinion, do that. And if the answer is continue, then it's
mm.
a great result financially.
Yeah. Perfect. I think that's a very balanced view. And but yeah, I think it's great for you to come onto my podcast and just raise awareness about this as well. Because a lot of doctors are too busy working, doing overtime, looking at the patients, and might not be aware of this, and maybe haven't had the chat with their accountant. So definitely, I think thanks for explaining that.
Yeah.
So we talked about debt recycling. We talked about some amazing case studies, as you said, even a 25-year-old. Um, I guess, do you want to share some, I guess, without identifying them, some of the other people I think before we came online, you've seen some doctors build even up to $8 million, I think, in investment portfolio, which is very well done. Besides kind of also looking at cash flow as well, is there anything else that they've done well to kind of achieve their point? Or is it, some people might say it's just because their income's so high, like, but surely, there's a difference though, because there's some people that might have a high income and not have much investments. So, kind of what are some characteristics of the doctors that have managed to build large portfolios?
Uh, high income generally is correct. So the clients I was referring to with the $8 million plus portfolios tend to be earning between 700 to 2 million
Yep,
even.
yep,
Right. So uh, you can still earn a high income and make bad investment decisions.
mm,
So what have they done well? It's that balance of yield on their property. So they're not just buying properties in inner cities. And if they are, they're finding ones probably on those around the cities, which is
mm,
still going to produce a decent rental return. And they're open to other areas, other regions
mm.
of country
Yeah,
where I guess what my point is, you want the property to be able to support itself at
yeah,
least at some point. And even if you're
yes,
covering cash flow for a period of
yes,
time, you want confidence. Why would you buy a stock if it's never going to pay you a dividend?
yep, mm,
Well, that's speculation, but it's higher risk.
yeah,
So I think the balance of yield and growth is critical.
yeah. I think One thing is, yeah, some doctors that I talk to just want to invest in their own suburb or own city because they feel more comfortable. But one thing I would challenge is like, even if it's a few suburbs away in your city, like if there's a maintenance issue, as if you're going to go over there and fix it yourself. Your
Correct.
time's more valuable. You're going to use a property manager anyway. And yeah, out of my yeah, investment property. I got to 12 in 8 years, and then building some more this year as well. And one thing is that's really helped me accelerate is kind of not just looking in my backyard. I think back to when I started, for my budget, 550,000, I could have bought a two-bedroom unit in, in the west of Sydney, Ashfield, or a house in Brisbane, and I've just sold that house in Brisbane 6 years later for double, 1.1 million. And I look back, I was just curious. I was like, if I bought the Ashfield unit, what would it be? And it was 800,000. So that's $300,000 of difference in capital growth just from one property decision. And imagine if you compound it over 5, 10, 15.
Exactly. That's a perfect case in point of the investment decision or purchase shouldn't be emotional. And it shouldn't be necessarily in your backyard. If you're making an investment call, you want to have as much of the market available to you, for which it is.
Mm.
And the cases where uh, maybe things haven't gone so well for my clients would be the doctor who is upgrading their home but wants to keep the current home as an investment property.
Ah,
And it
yeah,
turns out to be a terrible investment.
yeah,
It makes no sense. It's still worth 2.5, 3 million, say.
yeah,
The rental yield is, while the rent looks good on paper,
yeah,
it's actually not covering the mortgage repayments and interest only, isn't helping. It's still running at a loss. And we come back to that cash flow trap.
yeah.
So yeah,
Um,
I think
I
that's a really good
I
point.
think I've heard that people term that yeah, accidental property investor. You know how like they say like I don't know, is it 9% of the population have investment properties? I think a huge proportion of those is people that had an owner occupy and I think for sentimental reasons don't want to sell it. And but then they complain, oh, the tenant's not looking after it as much as I would have,
That's right.
and
Exactly. Yeah.
and you're right also as well, like Sydney, and you could say Melbourne, 2 mil plus has done pretty dismally over the last 5 years, while so many
Mhm.
other cities and towns have, doubled, even tripled, in some cases. So, the opportunity costs of holding, say you had 2 million in Sydney in the last 4 or 5 years, it's, if you adjust for inflation, it's probably gone backwards versus if you went into, buy 4 or 5 properties in Perth in 2021 and now
Ah,
double. Um, um, yeah, so opportunity costs. Yeah, I did an episode for listeners that are interested in the rise of borderless investing. So check those out. And yeah, you're right. I think for some doctors, I would say who have the or not just doctors, anyone who has the passion and the time, you can actually do it yourself. I've done episodes such as how to value a property, how to choose property managers, and yeah, definitely can do it yourself. But then also, I've talked to some doctors and acquaintances over the years that were like, oh yeah, I'm thinking about property investing, but I'm too busy. Maybe next month, and then we have a chat years later, and they still haven't done anything. So it's like if you have the passion, definitely do it yourself. After education, of course. But then if you know yourself and you're like so busy and maybe it is worthwhile outsourcing to a buyer's agent and purchasing as well.
I can't agree more. And there are some people who will not want to invest in the cost of a buyer's agent, and it's sometimes it's not a logical reason. I just don't want to spend it, but it can be money very well spent if they find you the right property that you can hold on for the long term that's sustainable, and you add the cost that comes onto your capital base,
Yeah, yeah,
uh,
when you sell it.
and
Yeah.
yeah, that's right. So I've seen pilots and doctors both do really well
Mm,
with a good buyer's agent helping
mm.
them.
So out of your doctors or non-doctors with the large, say, 8 mil plus portfolios, like what percentage of them kind of did it all themselves versus did, utilize buyer's agents?
Uh, I would say it's 50-50.
Okay.
Yeah. Yeah. Some have done it themselves because they've got the interest. Like you said, they've got the passion. It's not for them, it's not a time cost, it's an
Mm,
enjoyment
mm,
in looking up property and looking up different areas. Whereas the ones who engage a buyer's agent understand, I want to invest, but I don't have the time, and my time might be better spent taking, another, you know, shift at the
yeah.
hospital.
Yeah.
Um, well, if I'm going to earn another $10,000, this week,
Yeah.
well, that's money well spent versus spending days and days trying to find the right property, be unsure, be uncertain.
Exactly.
Uh,
Yeah. Yeah.
yeah.
Yeah. And I guess leading on to common mistakes that doctors do, I think one, as you said, might be retaining a former owner occupier when it might not make sense to do so, cash flow wise, or also, timing in the cycle. I think that's one thing I've learned as well. I've impart to our listeners as well is as I've grown up as an investor, yes, Warren Buffett or whatever time in the market definitely is important, but you can also see property markets tend to be cyclical as well, and often there are some warning signs. Of course, no one has a crystal ball, but you can look at so many metrics such as vacancy rates, days on markets, listings, supply coming on. Um, and there was another important one which escapes. Um, oh, affordability. I think the average, like the median house price versus the median income, and I think for Sydney it's something like 53 years, or something, and 53% of after-tax income towards the mortgage repayments versus some of the other states, it's like, say, closer to 30%. So I think there are metrics you can look at. And one thing I've realized is, for example, Perth, if you bought in 2008 and then held to 2018, if you adjust for inflation and stamp duty and holding costs, you've lost money. And then there probably were some investors like, I've had it, property investing doesn't work, I'm selling out in 2018, 2019. And then obviously some investors come in at 2019, 2020, and then it doubles over the next 4 years. So I think you can time it to some degree, and I guess different to, say, share market, for example, where a big fall might happen within hours or a day. Property, obviously is less liquid, and a bit slower, and often turns on the upside and downside a little bit slower as well.
Yeah.
Um,
I love the Perth example because I've seen a lot of people who sold out in that time period and
mm.
did so at a loss. And they might have been stuck in an equity trap
Yes.
as well for a
Negative
period of
negative
time.
equity was a real,
Cur
and still
cur
can be a real
cur
thing. Yeah.
that's right. And talking to, I mean, I speak to maybe five buyers agents each week. Normally, I get a phone call, wanting to an introduction, and I was surprised, given the experience of Perth to 20 years ago or 15 years ago, and how well it's done, and it appears to be continuing to do so
Mm.
at the moment. Um, that's where I think the good buyers agents have done very well for their clients in
Yeah.
Perth and the surrounds.
Yeah. Um, and I guess we'll finish up talking about trajectories. Obviously, junior doctors, might start 60, 70,000. I think maybe a slightly bit high now if you have some overtime. And then, as you said, registrars, I guess it really varies. If you're an anesthetic registrar working office hours, then, it'd be less than, say, you're a surgical registrar doing
Yes,
overtime
yes.
and callbacks and things like that. I don't know, registrar might be 120 all the way up to 250K possibly. And then obviously consultants, it depends on what specialty. So general practice, full time, this is publicly available, by the way.
Mm.
Might be around 250 to 350K, and then non-procedural specialists, say endocrinologist, pediatrician, might be a little bit higher than that. And then surgeons, yeah, like depending what special, yeah, it could be 1, 2 mil. Anaesthetist can be 700K to a mil. Maybe you've probably
That's
seen
right.
more
Yeah.
pay slips than me. And then I've heard even psychiatrists, which is interesting. And so some specialties kind of uh, not as attractive, and then maybe shortage, and then the incomes go up, and then so it's often cyclical as well. I think psychiatrists could make, I don't know, 700K to a mil as well. I
Yeah.
don't know if you have any
Yeah.
psychiatrists on your books.
I
Um,
actually don't, but I'm not surprised because you're right. I think there's been a low supply and and also a high need.
yes, yeah. I guess then let's go from junior, which could be the intern or registrar, compared to consultant. Like, is there any difference you would say that they need to consider in terms of finances and also investment, property investment?
I think it's comes down to are they going to be staying in the one spot or moving
Mm,
around?
that's a good
And that
question.
might have a consideration into what they decide to do,
Mm,
especially if you're moving around. My suggestion would be consider buying an investment property. Get your first property, get on the ladder, and that might help you then to make your next decision as your income grows.
mm.
As you reach that 250, three hundred
Yes.
thousand
Yeah.
dollar mark, suddenly you've got heaps, you've got your borrowing power explodes
Yeah.
all of a sudden. And you might be a husband and wife or a couple who are both in the medical profession
Yeah.
and quite a high household income. And you won't know yourself and what you can do
Mm.
at that point.
And I
Um,
guess
and
if you had bought an investment property when you're younger, then as your income rises, then you've got the equity as well. So then you're
spot
able to
on.
do way more versus, if you're both household combined income, say 500K, but then, maybe childcare expenses, private school expenses, expensive holidays. So you might be on high income, but then, you might have not that much savings so then if you had some equity in property, I think that can help.
Absolutely, and I've seen it multiple times. Some of my clients who are now, I've got quite a few anaesthetists as clients, earning that $700,000 mark thereabouts. But the good things that they did early on while they were registrars is buy an investment property.
Mm,
Then they've got equity, and then they can choose: do I keep growing my investment portfolio,
mm.
or say we've got kids, we actually really want to buy a family home, the forever home,
Yeah.
the
And now
nest.
you've settled down. Yeah. Now you're both consultants and actually know where you've got jobs. Yeah. I think that's the thing. A lot of doctors, I know I didn't realize when I entered medicine, there's actually a lot of moving around from medical school placements. And then also, even doing training is often, I'm pretty sure it's compulsory. Like you have to do some rural, rotations and stints. And maybe you might like that area, and often, some specialties actually have become super competitive. So, you might need to move even state, to get onto a
Yeah.
particular training program. Or maybe you haven't met your life partner yet. So like it is interesting. A lot of people say, "Oh, really want my own home because I'm sick of moving and paying rent." But there's opportunity costs. If you buy an owner occupier, and I've seen this happen as well, and then a few years later, oh, actually, I'm moving city for job or life partner or whatever, and then yeah, you're either stuck with a poor performing asset or you sell it, buy it, and some people have heard of changing their owner occupier like 5 times in 7 years. That's like 5 lots of stamp duty that you're just
Oh my
donating to the
God, yes,
government unnecessarily.
exactly.
Yeah,
Yeah. Well, the state governments will
yeah,
thank the people who do that. And it's a really good point because sometimes people or doctors, as they're going through training, think Sydney or Melbourne, that's where I'm going to be. Do a rural rotation in a Port Macquarie or a Ballarat in Victoria, somewhere, and realize, well, cost of housing is a lot cheaper here. I can earn the same amount of money. What does that mean for my lifestyle and for my capacity to further my investments? Substantial.
yeah.
It's not for everyone, but it is for quite a lot of clients I have.
Yeah. All right. Well, I think thank you for coming on to the show. I think a summary for me or take-home message for doctors would be number one, have a chat, consider debt recycling. Number two, even if you're a, intern, PGY1, PGY2, or registrar and slogging it out, and not earning that much, still consider property investing now, because it could set you up for the future when your income does rise. A lot of people say, I'm just going to wait. But as, as we say, property market in the last 5 years in certain markets have doubled. And, it's, I guess we can't go back in time, but we can always try and, make better future decisions. So that's number two. And number three, I would say is, yeah, surround yourself with a good team, such as a good mortgage broker or good buyer's agents, good accountants, just to make your life easier. But it's also good for you as well, because if you're a doctor or dentist listening to this podcast, that means you're already ahead of the game because you're taking an interest in your financial future. You're learning the lingo, the terms, and yes, you can outsource certain things, but I think you shouldn't outsource your understanding. Know exactly what they're proposing and does it make sense, and so that you're kind of, yeah, you're like kind of like the captain, the leader, but then you've got people working to the highest degree around you as well. Did you have anything to add, um, Dan Jones, for our listeners?
I think that was a great summary, and it is surrounding yourself with the right people. I'm not the mortgage broker for everyone. I will be for some people, but not for everyone. And there are a lot of good mortgage brokers out there. But the good accountant is critical. Um, the right buyer's agent, if you're going to outsource that service, decide what you want to outsource. Um, I would, back on mortgage broking and finance, I would encourage a broker versus going direct to bank because you've got choice, you've got options, and just know what they all of those are. And like you said, understand. So, you want to uh, utilize experience and expertise in areas other than your own profession, but understand it so you know you're making the right decision.
Yeah, perfect. Perfect way to end. How can people find out more about you and your business?
Yes, my website is specialistbroking.com.au. I'm on LinkedIn, I'm on Instagram. You can search specialist broking, we should come up. And that's probably the best step. My mobile number is on my website. I'm very um, approachable. I don't have a high volume of clients like a lot of mortgage broking firms. I typically work with people who need a higher level of debt with a higher income. So our service is fairly high touch. We're not, yeah, I'm not a 15-minute phone call and then I pass you on to the next person on the team and you never hear from me again. So I'm very happy for people to call me directly on my mobile. Email address is daniel@specialistbroking.com.au if anyone wants to email me.
Yeah, perfect. And thanks to our listeners for tuning into another episode. If you found this helpful, which I'm sure you will, share it with, yeah, someone else in your life that might be will benefit from this episode. Thinking about investment property, thinking about home loans, and for doctors as well. You can email me as well. I do have a Facebook group where we hold some regular Zoom sessions, just having informal chats about property as well. And thanks again for tuning into another episode. See you on the next one.